Great. Okay. Hey, everybody, and welcome to Stablecoins Are Killing It, episode number 8. I'm Lou Kerner with Crypto Mondays, coming to you from Greenwich, Connecticut. We've got a great show for you today. I'm joined today by Joel John, formerly with Outlier Ventures. He's an analyst, and he's got a blog at the Cipher on Substack that I think has really some of the best writing in crypto and stablecoin that I've seen. So welcome, Joel.
Hi there.
And we're also joined by Gil Hildebrand with Gilded. And let's see, here we go. With Gil Hildebrand from Gilded. And Gilded, is actually out there using stablecoins today as part of their global payments platform. So welcome, Gil.
Thanks, Lou. It's great to be here.
And Joel and Gil will give presentations for about 10 minutes each, and we'll follow that up with questions from the audience for the back half of the call. And so if you have a question, put it into the Q&A or chat on Zoom. And if we pick your question, we'll notify you. And then when it's your turn to ask a question, we'll open up your video and audio, and you can become a panelist and interact with Joel and Gil. We're recording the call today. We'll post it on YouTube in a couple days, so be aware of that. And with that, we're going to start with Gil. So Gil, now let me make you the host so you can share your screen. And there you go, Gil. Gil Hildebrand.
All right. All right, thanks, Lou. So today, I want to talk about something which is near and dear to my heart, the digital currency economy. And specifically, how can we grow it? How can we get the flywheel moving so that more consumers and businesses are using it? First, what is an economy? Well, the Google definition says the wealth and resources of a country or region, especially in terms of the production and consumption of goods and services. So what this diagram below shows is that consumers may purchase goods and services from one another, consumers may purchase from businesses, and businesses may also purchase from other businesses. So when we talk about the digital currency economy, we mean both consumers and businesses who are transacting in digital currency. Now, to go back to the last slide, we said that an economy is the resources of a country or a region. But very crucially, now with digital currency, we're talking about something that's truly global. That means it's location and government agnostic. And it's multi-currency, right? The barrier to swap one currency from another digitally is very, very minimal. And we're going to see that it's supported by both custodial and non-custodial financial service providers. So, we'll have the compounds and the Uniswaps of the world, but we'll also have the banks of the world who are getting involved in this too. How big is the digital currency economy today? This is the question that I get asked the most often. And first of all, we know that BitPay and Coin Payments have each said that in the past that they're processing $1 billion a year in digital currency transactions. That's actually pretty significant. And keep in mind that there could be many other people who are transacting outside of a payment processor. Now, Joel, this graph may look familiar because I stole it from you, but what we're looking at here is that in May 2020, the number of people receiving stablecoins is going parabolic. So in May, there were 700,000. Maybe we'll have an update to this soon, but it looks like it's growing incredibly. And how is it projected to grow over time? If you look at the green line here, this is actually the growth in the number of people on the internet since the year the internet was invented. And the gold line shows the number of people who have wallet addresses since digital currency was invented. And so you can see that roughly we're seeing a very similar growth curve, which means that this technology is changing the world as we speak. Now, this is the other thing people always want to know: what is Gilded seeing? So since January of this year, our B2B payment volume grew 1,200%, which means there are more and more businesses who are transacting with one another. And these are big payments. The average invoice size, $3,500. So we're talking significant amounts of money being moved. And this is coming, half of this traffic is coming from Europe, almost half, 40% from North America, 10% from Asia. Keep in mind, this is our unique perspective. This isn't necessarily the overall market, but this is what we see in B2B. In any
Gil,
healthy economy.
Gil, how else,
Yep.
when you think about your customer base that made up that data, other than thinking about them geographically, what other ways do you slice and dice them?
We're gonna get into that, talking a little bit more about the types of people who are using it today, at least from our perspective. So in any healthy economy, you're going to see a healthy amount of both supply and demand. And let's talk about those. On the demand side, who's receiving digital currency today in 2020? On the for consumers, the simplest thing we see is crypto investors and traders who are just looking to do more with it. We're also seeing freelancers who are in emerging markets. It's an easier way for them to get paid from international customers. On the business side, businesses that are in the blockchain industry, like for example, crypto miners, it's easier for them to pay with the digital currency they receive than it is to go and trade it on the market. So we're seeing, growth in the actual blockchain industry. We're also seeing small businesses in established markets with clients in the blockchain industry. So I think about this as adjacent companies, like maybe there's an IT firm that services a mining company, or there's a marketing company that has some blockchain clients. And these are in established markets within the United States, North America, and Europe. We're also seeing small businesses in emerging markets, especially professional services firms that can do their work digitally wherever they are in the world. And if they have international customers, this is just a great way for them to transact. And lastly, this is maybe the biggest group today, are e-commerce merchants who want to give customers more payment choices. And when we talk about BitPay and coin payments and their incredible growth, that's what they're mainly focused on. Now, on the supply side, who's actually spending it? For consumers, there's the diehard crypto fans. They just want to spend it wherever they can. There's privacy-minded individuals who want to pay for various online services, especially things like VPNs that they don't necessarily want that showing up in their bank account. And then there's individuals in emerging markets who they need an FX hedge because their local currency is devalued, and they want something more stable. For businesses, again, businesses that are in the blockchain in the blockchain industry that are receiving crypto as part of their core business. And second of all, we're seeing small businesses, a lot of them in the US, who are paying overseas contractors and vendors, especially in those verticals, again, like tech, marketing, design, things like that. Now, how does Gilded fit into this picture? So we're focused on B2B, and we think about both accounts receivable and accounts payable. So today, what this means for us is that we have an invoicing product. You can invoice your customers and receive payment in digital currency. In the future, we may offer some sort of checkout product, but we're not sure about that. But on the supply side, we think about accounts payable, which is paying vendors, being able to pay employees, and keeping track of all those records, automating the collection of it. Now, in the other bubbles below, these are services that either we integrate with today or we may integrate with in the future. The reason why I show this is because it helps you think about the layers that are necessary for businesses to be able to trust and begin to adopt digital currency. So they need it automated in their business process. They need more trust factors. They need someone to hold the funds for them. And then they need access to financial services and liquidity. So we are putting together all these pieces of the stack so that businesses can actually use it.
Hey, Gil, how on the custody side, obviously, there was some news yesterday in terms of, banks, the comptroller of the currency saying that banks are going to be able to custody cryptocurrency. Do you view that as a big deal?
It is one of the biggest deals I have seen in a very, very long time. And I'm going to get to that in a second, why I think that's so incredibly important, how big of a game changer it is.
Okay.
So, in the infrastructure, we have the exchanges who are exchanging between fiat and digital currency. We have the wallets that enable you to hold it. We have the different stablecoin issuers who, are accepting the fiat deposits and giving you a digital representation. And then we have companies working on payments. And there's a great quote from Sun Tzu that says the line between disorder and order lies in logistics. And so these infrastructure providers are increasingly professional, and that is growing the economy as well. Don't know what happened with this slide, but what I want to talk about is how liquidity is key. And so basically, if we have easy liquidity, then as the digital currency economy is growing, then people can easily move back and forth between the traditional financial system and the digital currency system. And so we have to see integration with existing tools and processes. For example, Gilded integrates with QuickBooks to make accounting easier. We have to see faster and cheaper exchange between fiat and crypto. And this is exactly what I was talking about with it being a big deal that banks can custody crypto. Because now that they can do this, if you want to start transacting in crypto and your bank offers a custodial account, you can set up that account and start trading without the KYC process that's involved in transacting with any other crypto exchange. It's really difficult and scary for people to pull out their driver's license and all this other information. If you can just get it from your bank, it's going to be a lot easier. And second of all, it's going to be a lot faster for liquidity because you're not having to transfer funds to a different place in order to trade with crypto. So that is a very huge deal. And lastly, greater B2B acceptance. So if businesses can transact with one another in digital currency, then that means they can accept it freely from consumers. And so that's going to be another big growth catalyst once we start seeing that. So lastly, how do we get the flywheel moving? And these are my predictions here. This year, I think we're going to see tighter bank and crypto exchange integrations so that we don't have to wait days for deposits and withdrawals. We're going to see wallet UIs that feel like using a bank account or a PayPal account. Of course, PayPal is moving into this too. Next year and the following year, we're going to see major platforms, Upwork, Facebook, and so on, offering digital currency payments. And we're going to see that most business tools have started to integrate it in some way. And in 2023 and beyond, we'll have mature regulations internationally. We'll see most banks offering digital currency accounts. And at that point, it's game over. We've got an entirely new financial system. So that's all. Thank you for having me here. And I look forward to answering any questions you guys have.
So Gil, thanks. One of the things that you didn't mention was, spent a whole lot of time on, was the impact of CBDCs on the stablecoin market.
Our CBDCs, digital currencies, yes, absolutely. To be frank, I am all about the open public blockchains and stablecoins. So I don't spend a lot of my cycles thinking about that. And I'd love to hear more discussion about that.
Okay, terrific. Thanks, Gil, and thanks for sticking around for the Q&A session. And with that, I'll hand it off to Joel. And Joel, you said you didn't have slides today. So I'll leave this screen up unless you want to grab the screen. You're the host, so you can grab the screen if you'd like.
I do want to grab the screen. I have some charts I would like to run through. So
okay, let me make sure. Whoops.
Just give me a minute.
Okay. Cool, you're the host.
All right. All right. So can you see my screen now?
Yes.
All right. Awesome.
You want to
So,
put it in, can you put it so that it has the whole screen?
sure. Better now?
Yes.
All right. So I'm sorry for the bare minimalism of the charts, but it's been put together in a rush. But just to give you guys context, I see the stablecoin ecosystem from the exact opposite point of view that our friend from Gilded here has, because I see it from the point of view of a customer that is based in Southeast Asia, whereas he is the founder of a firm from the US. So last year, while I was in Singapore, I was slowly seeing how a number of users in Singapore were using cards from the likes of crypto.com. And it became quite clear to me that stablecoins will become a foundational layer for the future of banking going forward. And that's what really piqued my interest in stablecoins. And since then, I've been trying to study what on-chain behavior tells about how this ecosystem is growing. So I have actually published two pieces around it, one in Q4 2019, and this is from Q2 2020. This is slightly before the DeFi hype just took off. So the next one would likely seem drastically different. But what we'll go through here is how growth has been trending within the stablecoin ecosystem and what are some general observations there. So the first thing to notice really is that although we keep saying that Tether, I mean, stablecoins have grown on to be a $10 billion ecosystem, the biggest risk here is that the vast majority of that is accounted for just within Tether initially. And if you exclude that, the vast majority are still between a handful of exchange related coins. So the closest actually decentralized alternative that you have, that's multilateral DAI, has only about 8% of the market share in terms of market supply today. And that shows to me that there is a long way to go for alternative approaches for stablecoins today. And that is something that you'll see when you study both their transactions and volume. Because while market supply can increase on basis of huge bank deposits, for instance, unless people are using it, it doesn't mean much, right? So what I noticed when I was studying both volume and transactions, as you can see here, is that about 70% of the transactions and volume is still concentrated around Tether. And a large chunk of the reason for that, based on conversations I've had in Southeast Asia, is that USDT is critical to the OTC ecosystem here. And that's why it will continue to have that dominance. But if you look carefully, you'll see that DAI is actually considerably one of the projects with higher transactions count. And that is partly because of the role that it plays in the DeFi ecosystem today. So then the question becomes, how do you like measure growth, right? Like the market supply increasing itself does not mean there is growth. You need to see actual transactions in it. And you will see here that much of the growth within the stablecoin ecosystem, at least until June, was concentrated around Tether. My hunch is that a large chunk of this growth was partly caused due to the high volatility in the Bitcoin market since March. And people started using stable coins as an alternative, and Tether became the critical tool that most people started using. So in order to understand how different chains behave, I kind of started looking at the average size of a transaction on each chain. And as you will notice here, the higher the average size of a transaction in each chain, my assumption is that lower the number of retail users using it. So if you look here, you'll notice that USDC has an average transaction that is in multiples of what DAI has, and that's been a steady trend over months. And I think once the numbers for DeFi comes in this month, I believe DAI's numbers would still be on the low. USDT and USDC's numbers would still be high because of the concentration the two coins have on Compound and Balancer today. So just to address what Gil was saying earlier, right? Is it whales using it, or is it your average retail users using it? In order to like explore this question, I basically cut down each transaction into different subgroups. So there were transactions that I categorized under 100, 1,000, 10,000, and so on. And what I noticed is that the vast majority of transactions fall in the subcategory that's there between $10,000 to $100,000. And this is where it becomes clear to me that the exchange ecosystem and the OTC ecosystem is the primary growth driver for stablecoins today. But that will likely not be the case forever. It's just that the product market fit today is there. And as the suite of applications around stablecoins change with things like lending and invoicing and other applications become more prominent, we'll likely see this number going considerably lower. And I think there's two key last metrics that I would like to share. So one is the on-chain volume, and the second is how exchanges are approaching this. So for me, stablecoins are going to be disrupting remittance as a market in the immediate future, and that's my personal assumption. And the way I keep track of that is by seeing how much volume is moved on remittance markets and how much has stablecoins moved. Of course, this is not a fair comparison because people keep moving money on stablecoins again and again, and it has a different purpose altogether. But for a sense of scale, stablecoins have moved about $250 billion on chain till June, and annually it should be in sync with the volume that remittance markets move. So I believe once layer 2 applications come of age and you have things like Argent and on-ramps improving, we would very likely be able to have the monetary bandwidth to take on larger applications like remittance. And this is the last bit that, yeah.
Joel, I'm sorry, go back to the last slide. And you had an earlier slide with similar data that showed kind of continued growth in Tether. But it looked like the declining growth in USDC and DAI, and that
yes,
I've read your posts that have that data, and that was, to me, that was very counterintuitive relative to what I assumed was happening. And so what do you think is happening that's driving that?
Yeah, so I think it's a matter of, I think, three key things, right? One is, again, I wouldn't want to like spread FUD, but there is likely a little bit of concerns around USDT's accounting, and people constantly look for alternatives, and that's where something like USDC comes in as a very likely alternative. From what I have understood, Paxos Gold has also worked with certain, Paxos has worked with certain distribution outlets in China, and you will soon enough see stablecoin white label solutions coming of age. So what that means is someone like me in India could launch a regional brand, but I would use the backend infrastructure of one of these providers to start launching stablecoins, and that would likely change how the market is structured. One area that I see this having played out already is with Compound. Because DAI supply is more or less capped, depending on how the MakerDAO ecosystem decides it should be. People take USDC and USDT as an alternative. And for large funds that are trying to do things like yield farming, USDC is a safer alternative because of how they are FDIC insured and they have a strong ecosystem around them.
So do you think the yield farming is, to some degree decreasing the transactions in those tokens, if that's what they're being used for, not being used to actually transact?
Yeah, that could very likely be the case, right? So I think my assumption here is I'll break it down to three things. One is the average size of a transaction will likely shoot up as large funds come in with larger transactions to do yield farming, because they wouldn't be moving these assets as much as, let's say, an average trader that's trying to trade perpetual swaps on, let's say, FTX. The number of transactions would decline. And therefore, you will see, higher volumes, but that may not necessarily indicate actual activity itself.
Okay.
Joel, I've got a question for you. So you mentioned that you broke out into buckets of transaction size, and the lowest bucket I saw started at $10,000. Did you have a bucket below that?
I did. So I did. So the numbers there, and I'm sorry for not adding it in here. It wouldn't have been visible, but I'll send you the link for that. But the numbers there is such that for micro transactions, right, like transactions up to $10, up to $50, the numbers are not soaring because of the gas expenses that's involved. But if I take the number of wallets doing these transactions and transactions between $100 to $1,000, definitely I do see signs of adoption. But it's still very early days today. My point is that this is like a fraction of what the ecosystem would be 5 years from now, right? Like we see applications like Axie Infinity, the gaming-based NFT world coming of age. We see applications that are focused on creatives and consultants and people that are engaged in what's called the passion economy, coming that are based on stablecoins. And I think those would be the ones that really change the story for stablecoins going forward. So I'll just end this with with another observation on how exchanges are seeing stablecoins, right? So when I was studying this, one thing I noticed is that there is almost a West versus East, philosophical difference when it comes to stablecoins. Most of the US exchanges, so if you look at Coinbase here, they almost don't dabble with USDT. They recently released a statement that they will have a custody for USDT, but I believe that that statement was taken down almost a couple hours after that. But if you look at the Asian exchanges, Huobi, OKX, Binance, they almost entirely thrive on USDT. And my assumption here is that it's a part of the reason for that is the mining ecosystem, and they tend to use the stable coins quite actively. So yeah, that's.
And just looking at this, Huobi, right? Huobi has their own stable coin. So so is there an interaction there, do you think, between USDT and the Huobi stablecoin?
It's likely going to happen. So last year when I was studying the Bitcoin balances of each of these exchanges, right? Huobi had one of the highest just sheer Bitcoin balances by virtue of being one of the old exchanges in this ecosystem. And I think they're likely looking at USDT and they're seeing the missed opportunity that's there, and they have good incentive to come out with their own stable coins and start capitalizing on that market. But it's still early days, and it's still with OKX, Binance, and each of these players launching their own variants. It's quite hard for exchanges to basically establish that that leadership position. For USDT, the advantage has been that the first mover advantage, and for USDC, it's been this FDIC insured, almost regulated stable coin that most people would rather use. So again, I may be being biased here for USDC. I totally get that, and none of this is to suggest there's anything wrong with USDT unless there's actual evidence, right? That's it.
Okay, terrific, Joel. That was awesome. And thanks for sticking around for the Q&A, which will start right now. And our first question comes from Glenn Rosenberg. Glenn, you need to unmute.
There you go. That'll help. Yeah, thanks. And as usual, opens up for so much thoughts and discussions and a lot of questions to ask. But I'm going to start off with just one that I was thinking about for either panelist, but it really clicked when Gil was talking about the news yesterday about the banks with the custody news. And, I'm wondering what your thoughts are on how this is going to impact the DeFi world, right? Because, decentralized finance is built on peer-to-peer transactions and, smart contracts, atomic swaps, and, all of those good buzzwords. And we know what the DeFi is aiming to do and how it's aiming to bring a lot of these traditional financial assets onto on-chain in a decentralized manner, and all of the companies that are working on that. But with banks able to custody, seems like a really big game changer. And again, just tying it back, I'm wondering what you think this will do to the growth of the DeFi world, and how that's going to be able to bring new projects and new product on chain.
That's a great question. I was joking yesterday on Twitter that I wonder how long it'll take for banks to realize that the best way to make money with crypto custody is to yield farm. I think, no, seriously, it's kind of an innovator's dilemma for the bank because, ultimately they're a middleman, and the digital currency is like removing middlemen. So it's going to be, the margins are going to get even thinner than they are now. And they're going to have to find new ways to make money. And some will make it and some won't. For the DeFi ecosystem, I think we're just going to see over time a massive influx in people using it. But I also think that some of the incredible yield and things that we're seeing today is going to decrease because, with more supply, there's naturally going to be a dampening of the demand for things like loan products, at least at what we're seeing today. And so the rates are going to come down. So that's unfortunate. But the thing is, the important thing is that digital currency being on an open blockchain is about choice. And so people previously wouldn't have access to financial services now have access. And that is really the big story here.
Yeah, do you want to add anything to that, Joel?
No, I think that's a fairly accurate summation of things.
Okay, terrific. So again, if anybody has a question, feel free to put it in the chat or the Q&A as we wait for additional questions. Joel, now that we're, obviously you talked about how USDC, because it's custodies, that a lot more people feel comfortable with it. Yet again, we saw it going down. If you were running USDC or looking to compete in the marketplace against Tether and their kind of dominant position, are there things that you would do if you were putting together a stable coin that you think would be able to better compete against Tether?
Yeah, so I think there's really three things. There's a few things that I believe USDC already does brilliantly. They do have systems in place that help founders start integrating USDC and receive a small interest rate spread. But I don't have the exact specifics of how they do it. But if I were in their shoes, there's really three things I would do. One is start investing actively in applications like Gilded and more or less try and be the financial infrastructure for applications that are trying to send money or receive money from much of the developing world. So what you have right now in places like India, Vietnam, large parts of Africa, is that you do have very good regional fintech ecosystems. You can send money within the country at actually costs that would be way better than what certain developed countries do. But when you need to get money out of the country, it's a long, painful process. So I would position USDC to be that financial layer that enables that to happen faster and better than banks can. The other thing that I would look at is, and I believe they're already doing this, is to be the preferred stablecoin for funds that are looking to enter DeFi today, because DAI does have that peg issue that it's dealing with. With Tether, there's been a number of concerns again and again. So if they can position themselves to be the go-to, again, quote unquote DeFi coin, then I think that's a good way for them to scale. But then again, I used it in quotes because there's a certain irony in using them for DeFi. But yeah.
And Gil, as somebody who's actually using, thanks for that, Joel. Gil, is somebody who's actually using stable coins. If you were going to be, starting a new stable coin, are there attributes that you would want, that you would provide, that you think the marketplace would value?
I think Joel's absolutely right that it's really about what Steve Ballmer would say as developers. To my knowledge, Tether does nothing for the developer ecosystem. In fact, we were basically told one time when we reached out to them that they just don't do business with American companies. I don't think that was an official statement or anything, but on the other hand,
and how did you reach out to them? Do you have a relationship with them, or
it was just a social media conversation that one of our team members had with someone there. I think if you look up Tether development tools, there's probably not a whole lot there. On the other hand, we have great relationships with both Circle and Coinbase, and they're very open, especially Circle. who is specifically, providing developer tools. So if we want to offer a custodial wallet that that enables us to, to have that experience for a customer while also, not becoming a money transmitter ourselves, Circle can enable us to do that. And certainly with Tether, that's not the case. And, I would, hesitate to think about custody of Tether at all. So I think that, on USDC and Paxos, by the way, are on a great path. We have a great relationship with Paxos as well. They've got a really good product, and there's huge news coming out of Paxos that they're powering crypto brokerage for both PayPal and for Revolut. And so that's astronomical news. Now, when people, learned about PayPal, doing crypto now, I didn't see anything yet about payments. And I think that that's actually the real story here, which is that PayPal knows that they're not going to be able to make a ton of money on providing a payment product for crypto because, they make money off of percentages. And, you shouldn't have that model with digital currency. Gilded doesn't have that model, by the way. We're a subscription service that is price-based.
Yeah, no, and I totally agree with you. But I mean, if you're PayPal and you see this coming and you believe in it, then, maybe it's better to cannibalize yourself than to have somebody else cannibalize you. And also,
yeah,
right, I mean, the market will, if you're PayPal, you have the ability to potentially dramatically grow the market.
No, that's true. And remember, I said liquidity is king. That is the name of the game right now, is liquidity, 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 because people need to be able to move in and out of the system as easily and cheaply as possible. And we're seeing so many different, competitors that are driving down the costs. But at the same time, they know that they're much more likely to be able to make money on the conversion than they are on the payment. So I think that PayPal is coming out with a trading product first and a payment product second, but we'll see.
Interesting. And, in terms of the money transmitter license on last week's show, I think it was, we had Bank Frick on. Mm-hmm. And I think it's them. I think they're using Second Life, or maybe Bank Frick has, and it's somebody else, but somebody's using Second Life. Basically is white labeling. They have a money transfer license that they're white labeling and letting, folks in the stablecoin ecosystem use it, to send stablecoins around. Super interesting. So we've got another question from Glenn. Glenn?
Yes, great. Yeah, so circling back to what Joel was talking about with the average size of the stablecoin transactions, I thought that was really interesting. And from what I gathered from that chart is that USDC is the predominant choice for transactions, particularly versus DAI. And what occurred to me when you were talking about that was that DAI, what I find problematic with DAI is that they have, I think an onerous over-collateralization philosophy, if you will, as particularly for multi-currency DAI, as well as a stability fee, which can be quite high and also challenging to really understand. So I was wondering what your thoughts are in terms of their methodology and their business model as being someone who could really compete long-term in using them for transactions.
Sure. So I think firstly, I would just say that we have to see these as gradual, ongoing experiments in pursuit of creating something that's decentralized enough, but also stable. And I think Maker does deserve a certain amount of credit for being one of the pioneers in doing what they did. On the collateral side, I do see the irony in needing more money to print less money and then using it. But as we saw with what happened in March 12th, these are extremely volatile assets, and that's why they keep such high collateral ratios. And I think over time, as we saw with Bitcoin recently, right, if we have prolonged periods of flat markets, we may likely see that collateral ratio going down, and that will likely be a function of the market maturing, and it will likely take a long time. The second is the stability fee itself is a function of MakerDAO's economic model. If the stability fee is not high enough, people may not have sufficient incentives to hold the token itself, which kind of brings down the price of the token itself. So it's not unlikely that we don't see more stablecoin experiments coming forward in the future, right? And one of them will likely be able to strike a certain balance between the stability fee and the collateral requirement. And we are already seeing it with things like MetaStable, which is using an index of coins. We're seeing it with Ampleforth. I'm not really dug in sufficiently into them, but they're also one of the contenders in that space. Been hearing quite a bit of funny things about them. But yeah, so I think we have to see for what it is. These are early stage experiments in monetary economics that's happening at a global scale. And what blockchains allow us to do is coordinate at the scale of the internet, at the speed of the internet. And that's beautiful. But I see what you mean completely, but yeah, we just have to be patient and get through it.
Yeah, Gil, anything to add?
The thing I have to add is on top of what Joel said, we have to give MakerDAO and DAI credit. I mean, they are the decentralized stablecoin, and we're talking about DeFi. That's it. You know, we've seen both Tether and USDC that have censored transactions, and DAI is the alternative to that. And like I said before, what's important is that we have choice now. We have, you know, this sort of intertwined multi-currency system now. But, you know, for the people who demand the security and safety of custodial accounts, of regulated stablecoins, they have that. And the people who want something that's more decentralized with fewer restrictions and more open access, they have that too. So I think a world without DAI is one that is scary for the digital currency economy.
But do you think that, you know, obviously I care very much about privacy and care very much about not being censored, but it doesn't look like the market cares very much about that at the moment, at least. You know, among your customers, is that something that that they seem to be concerned about?
Yeah, we see most people using PAX, BUSD, and USDC. A little bit of DAI, but I think the main issue for business in the United States with DAI is that it simply is a little more volatile, and that just makes all the accounting and everything more difficult. But that being said, I truly believe that the choice is important. And, you know, in the traditional economy, everyone talks about going cashless. And, you know, in some ways that's good, but in some ways it's really bad because, you know, we should have the ability to transact without middlemen and without, you know, a centralized party. And that's going away, but we need an alternative in the digital age.
Yeah, Joel, when you look at the marketplace, do you see the fact that DAI is struggling to, maintain its peg, not that it's under the peg, right? But the fact that it's over the peg now for a considerable period of time. You know, how do you put that into context?
So I think if you're someone from, let's say, India or Vietnam, which are huge markets for these stablecoin applications, and you're building on DAI today, and you can't guarantee that this asset is going to stay at $1, you would likely lose users, even if it's going higher or lower, because someone that's trying to make payments in DAI all of a sudden has this 3-cent premium that they have to make on top of the other expenses that accrue, right? So I think what I likely see happening is, as the volume around DAI increases, you will likely have these products that allow you to guarantee a $1 redemption. So it could be likely through hedge instruments and futures and things like those. Some of it already exists, but that ecosystem would likely be what makes it possible for DAI to be constantly at $1 in the future. And I wouldn't be surprised to see something like a curve.fi or a synthetic market for trading DAI futures that then settles against transactions being used as the means through which this peg is maintained. What I've seen from Maker constantly is that they do add more and more.
So that's a way that you see of them being able to maintain the decentralization and maintain the peg, which is obviously a struggle at the moment.
I just realized it'll be a very interesting application to build to. And I do see a lot of yield coming out of it, right? Because it's something that it would be right up there with curve.fi and some of the other stablecoin based products. But it will be a requisite because I don't see adding more collateral being the solution here. You do need a more complex financial ecosystem around the instrument itself. Just like how you have it for forex markets and commodities today. That's likely going to be where this heads.
Okay, cool. Glenn, are you good?
Yes, thank you.
Okay.
I mean, I did have one other follow-up thought real fast if nobody else has a question, which is just that as we extend the conversation through, how to create stable coins, and we've talked about this a little bit, what your belief or forecast, either Joel or Gil, for bringing other types of financial assets on chain to create, stable coins. And, clearly they would have to be low volatility assets, but also potentially with some kind of yield or return, which could be attractive to the user. And if you're seeing anything getting adopted there.
Gil, would you like to go first?
You can take that one, Joel.
You're muted.
Oh yeah. Oh, okay. So I think it's mute. No, you can.
We can hear you, Joel.
All right. Yeah. So I was just thinking. I think broadly, there's going to be three things that's happening that will likely happen. One is your CBDC and stablecoin ecosystem will interact. I'm just what do you say? Making assumptions here. This could be very wrong. But the idea that money is digital would be strongly entrenched in multiple parts of the world, and you would likely have an intersection of CBDCs and stablecoins, and that would likely increase your on-chain payments that happens. So one way I saw this happening in India is 2016, we had this huge event called demonetization where the government just said none of our currency is valid anymore, and you had to go through this process to get new currency. But what happened is a lot of people started paying online completely. So if you go to a lot of countries across Southeast Asia, payments are purely digital, and I see that transition happening to stablecoins. The question then becomes is, if it is a stable coin, would it be purely decentralized or would it be something like USDC that we have today? I think because there's so much of a risk going through completely decentralized products, you would likely see a great amount of centralization kicking in. And I think we saw that with music once, right? Like Napster was the P2P solution. iTunes came in, it had better unit economics, but it was still expensive. And then Spotify came in and it bundled the whole thing. And at some point, Spotify also had a peer-to-peer backend towards it. I could also argue that Spotify is still peer-to-peer because independent creators just upload music in some cases. We will see the same happening with money today. What we're seeing today is still the Napster era. And as ideological as we would like to be, there would likely be centralization creeping in different forms. And those would be the big unicorn applications going ahead. That's my assumption. I would be happy to be wrong.
Gil, anything to add?
Yeah, I again, liquidity is king, and the news with the banks being able to cut the crypto assets means that, in the next year or 2 years, when they start rolling out these products, we are going to see a ton of money that moves from the traditional financial system to the new ecosystem, and it will be done using regulated stable coins, that are fiat backed. So I think what DAI is doing with combining multiple types of collateral may make sense for them, since they have a different type of way to maintain their peg. But for the most part, I see people handing in their old money to get some of this new money, and it's still going to be fiat backed, at least for the near future.
Okay, makes sense. So we finished the show, and Glenn, thanks for the questions. So finish the show with 2 questions. So Gil, you can start with the first question. So in the time that you've been in the space, what has surprised you most about what you've seen in the stablecoin ecosystem?
What has surprised me the most? Well, I think that the thing that's most surprising is that in 2017 and 2018, when I first got involved in this industry, we saw this incredible, bust basically in 2018, and people became very, very cynical about what I call crypto payments, which is like the V1 of crypto payments. There were issues around the volatility. There were issues around the taxes. There were issues around the fees and all these things. And it was really too difficult for people to use. But the tools have gotten so much better. With Coinbase, you can purchase USDC with no fees at all. That's just one of many examples. Circle's got, Circle, Paxos, all the other stablecoin issuers are starting to create great tools for developers. They're starting to be integrated, but people in our industry are really cynical still about crypto payments because they have, that V1 in mind. And so for a lot of them, it's been difficult to get them to switch over. But that being said, I think that, in the near future, the tools like Gilded and other tools that are out there are just going to keep getting better and better until it's no different from using any other financial product that you're used to. And, really you can enjoy all the benefits.
Cool. Joel, what's been your biggest surprise in the time that you've spent in the stablecoin ecosystem?
Right. So I think it actually goes back to 2013, because when I first started looking at Bitcoin, I was looking at a stable way of sending money home from the Middle East to India, which is where I'm from. And I think 7-8 years on, we finally have an application that can likely do it, but nobody is rushing into investing into it or building actual applications around it. Most people are still tied up in the yield mania that's going on. And that surprises me a little, because here's a completely new way of doing businesses. Sure, you need regulators on board, but I would anticipate more application layer investments and founders coming forward. And just not seeing as many people as I thought I would see is a little surprising for me, I would say. Because this is what a lot of early Bitcoin folks are trying to do, right? Like, you finally have that stack here. Why not just go ahead and do it now?
So, and that's interesting that, that might lead into your answer for the second question, which is, if, we're here a year from today, what do you think we'll be talking about, a year from today that we're not talking about today? So a year is too close, and I'm not sure on what would happen, right? The SEC could be after everyone. I hope not, but things could go in multiple directions. But my hope is that in 2-3 years from now, is that a lot of investors would look at the application layer and realize that they missed out on the Ubers and eBays of this new web. Whenever I speak to potential venture capitalists or founders, that's what I keep saying. Look at the application layer, because it's not too competitive right now. And if you're building for niche markets, you likely have an edge that most of your peers won't. And ideally, I will be discussing with you about unicorns that come out of it, because I want to see multi-billion-dollar companies being built on top of this as a financial stack. And we have that happening already. We have Provenance.io, Figure.io. These private chains are becoming billion-dollar companies. It's only a matter of time before these public coin projects reach that stage. Very cool from your mouth. Gil, so you've got the last word. What do you think we're going to be talking about a year from today in the stablecoin ecosystem that we're not talking about today?
What will we be talking about that we're not talking about today? We'll be talking about people using it every day, and not everyone, but we will have those use cases. We will know someone who is using it regularly, and I think it's going to grow astronomically over the next few years. But now we're finally starting to get to the point where there's real utility there, and with the banks and others coming into the mix, it's going to be easy, and people will be able to benefit from it. And we're going to talk about how obvious it was that this was coming.
Yeah, it does. I mean, my guess is it looks obvious to most of the people on the call. And one of the things I'm most surprised by is, is how little attention it's getting from the rest of the world, given how obvious it seems. So with that, thanks a lot, Gil. Thanks a lot, Joel, for the time. Thanks everybody on the call. Next week, we've got Stablecoins Are Killing It, episode number 10. And we're going to be featuring Ryan Watkins with Masari, who just came out with their Q2 review of the entire crypto ecosystems. It was largely focused on stablecoins, not shockingly, because stablecoins are killing it. Thanks, everybody.
Goodbye.
All right. Thank you. Take care.